Good evening, viewers. This is CPA Charles Kafela again, and today we are going to resume our series on financial reporting, and today's class is about IAS 40 investment property. In the last video we talked about the IAS 16, that was PPE, and we really went ahead and discussed most of the non-current assets. We gave a demonstration on how they are all being treated in terms of when you're handling non-current assets. You look at the nature, you look at the purpose, and we classified them into the tangible, non-tangible, intangible assets. Intangible, that was I-38, and these tangible assets, we had the PPE, which went to IAS 16, and we have the IAS 40, that is investment property. The difference between the investment property and PPE is on the side of the use, because all of them are tangible assets. But PPE, they are used within the organization to generate revenue in the production or supply of goods and services for the organization, or for rental to others to a smaller extent, and or for administrative purposes. But this investment property is mainly focusing on those assets. They are tangible in nature, they are owned by the organization, and they are only responsible for generating rental income, mainly generating rental income. Secondly, they are set aside for capital appreciation. We said capital appreciation was all about leaving the asset there to accumulate for its value to accumulate. If you buy 10 million, in 10 years time you may find it is 100 million. So that's what we call the capital accumulation or appreciation, increase in the value of the asset. So basically it is either you are earning rental income or capital appreciation, or both. You may be using the asset to earn a rental at the same time capital accumulation. So that's basically how we distinguish. The distinction is only on the purpose of the asset. These ones are used for rental, mainly rental income, for earning rental income and capital appreciation. The other one, administrative purposes and production, for earning revenue for the organization. So that's basically how we can differentiate the two. So when you're looking at IAS 40 investment property, first of all we have to determine what is investment property, the definition. Having known that, we can talk about the recognition criteria. How do you know that you have an investment property? Then we go to the measurement basis. How are you recognizing, or how are you incorporating, or which value are you going to assign to that asset? Those are the things we are going to be looking at for now. Without wasting more time, let's kick off and go through our notices, and we see we are saying investment property. This is the property. It must be a tangible. This is a tangible asset or a property. In other words, it's land or building or part of the building or both. I said if I talk about part of the building may be earning rental, and the other part is maybe administration. So we are going to look at those scenarios. That's why I'm saying land or building, or part of the building, or both. That is held by an entity for capital appreciation or both. I did not put the one for rental income. They are used we are saying these assets, they are used for earning rental income, or they are used for capital appreciation. For capital appreciation, or we can add something here, all for earning rental income. For earning rental income or both. It can be used for earning rental income or both. Either capital appreciation or for earning rental income, or both. And we are saying capital appreciation is just holding the assets for accumulating of income, increasing the income. Those ones we spoke about them. Then let's look at what are some of the examples of investment property. If someone says, I have an investment property, what are some of the examples? One, we have land for long-term capital appreciation. You have bought land, you have not constructed anything there, but you've just bought land and left it somewhere. Or you bought land in a growing environment area, but you have not done anything on it. That's what we call, at that point we say that it is bought for capital appreciation, even if it is not the intention. But that's how it's going to be looked at, or how it's going to be accounted for. Then we have land acquired by an entity, but whose purpose is not yet determined. If you have acquired land, but you have not determined which activity are you going to be using for that land for, then we say that at that point it is held for capital appreciation. It is held to increase income or to increase its value. Then the other one, we can talk about a building that is leased out under operating lease. Operating lease, we shall talk about it when we go to IFRS 16, those are leases, and that's where we will look at the finance lease and the operating lease. But what you need to know from here is that operating lease, those are short-term leases. You lease the asset maybe to, if let's say the useful life of the asset is 10 years, but you lease it for like 3 years. So it's still, the owner still has the 7 years of ownership. But this financing lease is the situation whereby you lease the asset as if you have already bought it. Someone leases the asset, the useful life of the asset is 10 years. Someone leases it for 9 years. It's like you have bought the asset, because by the time you leave the asset, it is already even old, if it was depreciable asset. So that's basically what we can talk about in terms of the operating leases and the finance leases. But those ones we are going to learn, we have a separate standard for that. That is IFRS 16. So the next one we can talk about is the building that is vacant but will be leased out in the future. You have constructed a house, you have not done anything, but it's still there. But its main intention is to lease it out to earn rental income. Either to earn rental income or to do other things. That's basically, we can talk about that. Those are some of the examples of the assets we can call that they are investment in nature. So the next slide is all about It's all about the properties which are not investment properties. We have to look at them so that when you see them, you know that this belongs to another. Remember, I said in the previous videos, I've been saying that any asset that is accounted for under different standard, it cannot be accounted for in another standard at the same time. So take note of that. Then here we are saying that we have properties which are not investment property. When you see them, just know they are not investment property. We have owner-occupied properties. Owner-occupied property, we talked about them as they are under PPE. That is IS 16. Because we said those that are used for the administration of the organization or for the production or supply of goods and services. It's like if you see the school buildings, they are constructed, but it is the school which uses them. So they are PPE. So that's one of the items that don't fall under the category of investment property. Secondly, we have the property that are held for sale. Properties that are held for sale, that is inventory. You can look at the real estate companies. They deal in land. That's what they sell. They buy and they sell land. They buy and they sell building. So that's inventory. That's their inventory. So don't call that, because that's basically the business. That's their stock they deal in. So that's treated under IS 2. That is inventory. Then properties constructed on behalf of third parties. These are also not investment properties. You are a construction company and you've got a contract to construct a building. That building you are constructing is not yours. You are just a construction company. And we account for those ones under IFRS 15, that is revenue. Revenues from contracts with customers. That's where we account for those ones. Properties constructed on behalf of third parties. It's like I've given an example. You're a construction company and you're constructing houses or buildings, different buildings to the customer. Then the last one, we can talk about buildings that are leased out under finance lease. Because remember there we said buildings that are leased out under operating lease, those are the ones that are falling, the short-term one. But the one which are long-term, they are accounted for under IFRS 15. We shall understand these leases when we go to IFRS 15, because this IFRS 15 was reintroduced, was modified, and that operating and finance lease, when you reach there, they are not separated a bit. So we shall learn those ones when you reach there. But just know for now, buildings that are leased out under finance lease are accounted for under IFRS 15, that is leases. So that's basically what we can talk about. Maybe what we need to go into deeper is, this is going to be our story. For every standard, we have to look at what is the standard saying about how to recognize it. We said recognition, those are conditions that are set, or criteria that are set for someone to recognize that you have an investment property. Then when we go to measurement, we are talking about which value. Yes, you have recognized you have an investment property, but which value are you taking? So be able to get those differences. Then we are saying recognition, the recognition criteria for assets, it's more or less the same. It's more or less the same. We are saying that the recognition criteria, we are saying that it's probable that future economic benefits associated with the asset will flow to the entity. Future economic benefits, but if you should also be able to understand this, it's probable If someone says it's probable, it means at least its percentage is more than 50%. The probability of it to occur. I'm not teaching probability, but the probability of something to occur is more than 50%. That's what we can call that asset, that it is probable that future economic benefits associated with the asset will flow to the entity. Meaning it is beyond doubt, it is more than 50%. You are sure the asset will bring value. Not the thing of saying it is 20% and you say it is probable. We shall see those things when we go to provisions, contingent assets and contingent liabilities. We shall have to see them from there. Then the next one is the cost of the asset can be measured reliably. If you can't determine the cost, then what are you going to be recognizing? You can't recognize something. Remember, in accounting, we only recognize financial transactions or monetary transactions. Then, after looking at the recognition criteria or the recognition of the investment property, let's look at the measurement of investment property. We said when you are looking at the measurement, we are trying to look at which values are we going to incorporate in our financial statements. Which figure are we going to put in our statements? One, we said we do the things in two ways. How we can measure an item. One, we do it at initial measurement, when you have just recognized the asset, or when you have just acquired the asset. Which value are you going to assign to that asset? That's what we call the initial measurement. Subsequent measurement is at the reporting date. Yes, you acquired that cost, that investment property at 10 million, but has it reduced the value? Or are you going to still maintain the same cost? Are you going to use the cost model, or you are going to use the fair value model, or you are going to use the evaluation model, or it is a present, whatever? That's basically what we are talking about here. That's why in our first video we spoke about the measurement basis, and we did even some computations, so that to be able to analyze where we are heading. So if you see you are not understanding, please make sure you go back and you rewatch the videos and be able to understand before you progress to the next videos. Okay, we are saying that initially this is how the standard says. IS 40 says that we initially measure investment property at cost, and we say that cost is very broad. We don't talk about the purchase price. We incorporate in other costs that are directly attributable to the asset. And here now we are seeing there are legal fees, transfer fees, because this is mainly based on land and buildings. They are land and buildings. So when you're buying land, of course, you expect legal fees, transferring of the land titles. Then brokerage. You have to pay brokers who are going to connect you to the real estate agents. So when you are determining this initial measurement, there is something maybe I didn't talk about when I was in IS 16 about the initial measurement when you are measuring at cost. There are certain expenditures, or there are certain costs that we are not supposed to include in the cost of the asset. If, let's say, these assets in the PPE, I did not talk about that item, and I saw it is a bit challenging for students. So we have exclusions in the cost. We have these administrative and general overheads. Those are indirect costs. They are not supposed to be part of. Even here, when you are determining, because they may give you the raw figures, they give you the purchase, they give you other costs, and you are supposed to remember these costs which are not directly attributed to the cost. They are not. If, let's say, we have the pre-production or startup costs, these pre-production costs, I can talk about them. If, let's say, you have acquired a machine and you want that machine to produce goods, first of all, you may do an initial testing, but you have already purchased the item and the item is working. But this initial testing you are doing, the asset is you want to confirm whether the asset can produce the required quality. That cost or pre-production testing we do, we are not supposed to, that cost we are incurring there is not supposed to be capitalized, or is not supposed to be included, because by the time you start production, you have already, the item is already working, so you don't include it. Even there is even scenarios you may sell those items you have produced. Remember, they were in the pre-production. When you sell them, those items you are selling, even if you make a loss on them, by the time you make a loss, you have already produced. So we don't incorporate them. So those are basically the things I wanted you to get to know, what we are supposed to, what are some of the exclusions. We said losses, pre-preparation costs, and administrative overheads. That's basically what even here they may bring it, and they are giving you the cost, a purchase price, the others, like the way we said. So long as something is determined at a cost, we don't look at the purchase price only, we look at the other direct costs that are associated with the asset. Hope we can proceed from there. And we say measurement, subsequent measurement. When we look at the subsequent measurement, we said that is at the reporting date or at the end of the year. Which figure are you going to carry to the bank statement, to the balance sheet, or which figures are you going to be taking if they are current assets? Which figures are you going to be taking to other incomes if they belong to the financial statement, financial position, financial performance, this income statement? So that's basically what we are looking at. We are saying there are also two ways, or the measurement bases that we can use subsequently, and one is a cost model, the other one is a fair value model. For investment properties, we don't revalue them. We don't use like the valuation model. It's only cost, and we can take them at cost, or we take them at their fair value, or the current. We said the fair value is the current market price, and this current market price is fair to the extent that there is no even cheating, because you go there and you start bargaining. It is what is prevailing in the market that will determine the cost of that item. It is very fair. That's why we call it fair value. Because you go there, the market forces of demand and supply, they are the ones to determine that at least at this moment and at this time, the item is costing this if you are to sell. And that's it. It's not revaluation, but we are doing exactly what it is now. Remember, with the revaluation, you do some technicalities. You have to look at how long will this asset again stay. If at all it has moved for this, if it goes like this, how much? How are we expecting for that asset to be depreciating? So all those things. But here we are looking at the fair value, what is really existing in the market. So we are saying subsequently we can measure investment property at cost, and we say that the cost is cost less accumulated depreciation and accumulated impairment losses, because we are at the reporting date. We expect that these assets are going to be reducing in value, either if they are not depreciable assets like land, there may be impairment loss. We say that the difference between impairment and the valuation and depreciation. Depreciation is spreading the cost over its useful life, but impairment is that the cost, the asset has decreased in value. That's basically how we can define those ones. Then, when we try to look at the fair value model, we are saying that assets are carried at fair value or actual market value. Then there is a scenario that will happen that cost we paid at initial recognition, when you look at what we are actually getting from the market, there is either loss or a gain. These are called changes in fair value. They may be at a loss or at a gain. And we are saying, since this is where I want you guys to get me, this fair value is to the extent that the price is fair, is free and fair. It means that these gains and losses, they are supposed to be taken to the profit and loss, because at the end of the day, they are actually realized that's what you are going to get in actual sense if you are to sell. If you had an asset and you are to sell it, what they tell you from the market, what they are buying, is actually what they are buying. So it's like they are realized. So that's why they are taken to the profit and loss, not to the OCI. We take them to the profit and loss under other incomes, where we add, at that section where there is gross profit, add the other incomes, we add them. Discount received, then these gains, fair value gains. Hope you've got a difference why we are not taking the revaluation gains there and we are taking these. Hope that helps and it can make you really understand those things. Then let's try to look at, there are some items that we can be looking at. Having seen the recognition, then we want to look at the properties with the dual purpose. Properties with the dual purpose. Dual means two, meaning that item is serving two purposes. They may be different. It may be it is the same item, but that item is an investment property, but it is used for rental and at the same time is used for capital appreciation. This is not what I'm talking about. What I'm only talking about is that the asset is used for rental income or capital appreciation, at the same time it is used for another purpose. That's why I said when you're talking about these non-current assets, the purpose is very, very important. We are saying that a property may be used for production or supply of goods and services, or for administrative purposes, and may be used for earning rental income or capital appreciation. Then the gist is, how do we treat those assets that are dual purpose? We use them, we rent them out, and at the same time they are used in the business. We use them for capital appreciation, and at the same time we use them as a head office. Then this is what happens, because there are those apartments. You may find the apartment, one of the apartment upward is in the last floors, they are just renting them. And down one, they are the ones that where we located our head office. So how do we treat those ones? Then we are saying that we have three scenarios. One, we are saying if the asset, actually I should change maybe these ones to, I give them a different bullet. Anyway, may go like that. We are saying if the portion can be separated, and separation we are talking about if it can be rented out separately or sold separately, like these condominium sellings whereby someone can be on the 4th floor and says, I have a title for that, whatever, I bought this floor is mine, this one is not mine, like that. If it can be sold separately, then they will be accounted for under their respective standards. If that thing can be separated, you can identify it separately and you say this part, this level, if let's say level 3, level 4 on on an apartment is mainly for rental. Then the downer part is the one we use level 1. Level 1 maybe and level 2, they are the ones we use for administrative purposes. Then what we do, we account the level 1 and the level 2 under investment property, and we account level 1 and level 2 under PPE because they are used for administrative purposes. Then there is also a scenario whereby these assets you can't differentiate them. Like you may find on level 2 they are all on level 1, but on level 1 there is a portion for rental, there is a portion for administration or a branch, there is a portion for other thing. Then that's where the scenario becomes tough, and we are saying that if the portions are not separable, then the properties will be PPE under IS 16 if, make sure this if is sticking to your head. This if is very important. If an insignificant portion is held for earning rental income or capital appreciation. What does that statement means is that if the whole asset is maybe used for administration, but a small portion, maybe 2 rooms on the last floor, they are used for rental and capital appreciation or rental for earning rental income, then we can say that is insignificant. Insignificant means something is not enough, like it's a small portion. The problem with this standard, it did not specify how can you know that this one is insignificant, but at least you can see. If on the whole building, depending on the scenario and the question, if on the whole building you have, let's say, 2 rooms that are used for rental, but the room has, let's say, 11 floors, you can't really consider that one to be something significant. That's how basically you can tell, but it depends on the scenarios in the question. But when they are given the question, they will tell you exactly what they mean. But it is you to understand that is this really significant or insignificant. Then the other one is if the insignificant portion is owner occupied. If, let's say, on the whole building the head office has, maybe it has only 1 branch and it is using only 1 room or 2 rooms, but all of the other rooms are used for capital appreciation or rental to other people, then you just say that is supposed to be treated under IS 40, that is investment property, because the other one we take it to be insignificant. Hope that one helps. If you don't understand, please rewatch and you'll be able to grasp these concepts, because they are going to be important. Those are the scenarios that are coming in those questions. So let's proceed to the next one, and we are saying the next one is all about, we are going to be talking about the transfers. There are certain situations which may happen that the land which was initially used for head office, the head office has left, or maybe the head office has constructed another building and now they are leaving this building for capital appreciation or as investment property or to be rented out by others. There is a scenario also whereby the buildings that were being rented by other people, they are now being occupied by the organization itself, meaning there is that transfer whereby the asset which was used for earning rental income is now being used for office purposes. How do we treat that? If it was an investment property and it is now becoming an inventory, or they are going to sell it in the normal course of business, how do we deal with those items? Those are the things we are going to be looking at. One, we have a transfer from IS 40. When I say IS 40, that is investment property, to IS 16, that is PPE. Transfer from IS 40 to IS 16, how do you recognize that there is a transfer? Of course, if there is a transfer, then the other recognition criteria for PPE, they will come in. Basically, how do you tell that the item has moved from an investment property to PPE? One, you will have to see the purpose, because I said first look at the type of the asset. But remember here, the type of the asset doesn't matter because all of them are non-current assets. Then the second thing you are supposed to look at the use of the asset or the purpose of the asset. Here we are saying if it is PPE, it has been investment property. It has been used for capital appreciation and rental to others, or for earning rental income, but it is now becoming an owner-occupied, or it has been converted into a head office or administrative purposes, or it is being used in the production of income. So we are saying this is evidenced by commencement of owner-occupation, and owner-occupation brings about the administrative purpose. Actually, what you need to know is that when there is any transfer, first look at what is that item being used for. Is it being put to sell? Has it been put to an office? Has the company occupied that room, or it has been given out? So we are saying transfer from IS 40 to IS 16, this is evidenced by commencement of ownership. That's the first thing you recognize. Evidence must be there. And we are saying that for a purpose, for a transfer from investment property, under that is carried at a fair value. Remember we said within the investment property, subsequently we measure these items at fair value. So we transfer them at their fair value. If it is moving from IS 40 to PPE, we transfer them at their fair value to owner occupied. Because what will happen is that if you are transferring the asset now, what will be the cost you are going to assign to that asset where it is going? If it is going to become an item of PPE, then at what value, what will be its measurement? Then this means that its fair value at the date of change will be its value initially. Meaning that for a transfer from investment property under that is carried at a fair value to owner occupied property under IS 16. The property's fair value on the date of change in use will be its cost for subsequent accounting under IS 16. Meaning, by the time you will be reporting that asset, it will be using its fair value at the date of acquisition. That will be the amount you'll be using. Then we have transfer from IS 40 to IS 2. We say the IS 2 is inventory. If the item is moving from IS 2 from investment property to inventory, how do you know that this item has been converted from IS 40 investment property to inventory? Inventory, we are saying that it has been put to sell. So how do you see that this asset is now going to be sold? One, the evidence is that you know, when you're selling assets, you make sure that at least you do some renovations so that the asset can pick a higher value from the market. That's basically what we are talking about here. And we are saying that if you are converting that asset from investment property to inventory, then the evidence, this is evidenced by the development of the property with the view of selling it. Of course, when you are selling, when you want to sell especially an asset, these non-current assets, you modify them. If it is a tractor, you put some color and whatever. You do some repairs so that if someone does a road checkup, it can be really working good, so that you can be able to maximize the amount you are supposed to get from that asset. So we are saying for a transfer from IS40 investment property that is carried at fair value. Remember, anything that is coming from IS40, it is coming at fair value. We don't have revaluation. We pick the estimated market price, and that estimated market price will be the value that we will account for under inventory. How will I account for that transfer? I will transfer that asset. Instead of putting them in non-current assets, I will put them in current assets under the name of inventory or stock, probably closing stock, because it's the one that goes in the balance sheet. And we are saying that the property's fair value on the date of change in use will be assumed. Actually, it will be the assumed, it will be the assumed cost under IS2, that is inventory. Meaning the fair value by the time you are converting, or the fair value at that time of conversion, is going to be the same cost for that asset that we are going to be used for subsequent reporting. Hope you can be able to get that. Then the last view is that when you are transferring now, we've been transferring assets from investment property to other standards, but now we are transferring items from PPE to IS40. Remember, these other reversals, if the asset is coming from inventory to IS40, you reverse the concept, because that's what the standard is silent about that. But you reverse the concept. But there are some transfers which have some issues. That's why they are given out. So IS16 to IS40, this is evidenced by cessation or ending of owner occupation. Remember, we said in IS16 PPE that they are used by the owners for generation of revenue. So if they stop using them and they give to others, that's what we call cessation or ending of owner occupation. They are no longer being used by the organization. So we are saying that for a transfer from PPE to IS40, that is investment property, that will be carried at fair value, the difference between the carrying amount under IS16 PPE and the fair value on the date of change is the change in use will be accounted for and as a revaluation. What happens, what basically this means is that when you are transferring items of PPE to IS40, we transfer them at the revalued amount, because the revalued amount is actually the fair, it is reflecting the fair value. More or less it is not actual, but at least it is. That difference is what we call the revaluation. It's like you have revalued, but basically they are transferred at fair value. That's what the standard says. But at least that difference, it will be either It will be the revaluation, either gain or loss, and it should be accounted for as a revaluation. So there is a question, trial question, that is trial number, that is June 2013, question 5C. That one we shall look at it later. Let's first resume and we finalize. I hope we have finalized with this. The rest of the disclosure requirements and all that, those ones you can read on your own, but be able to read them. Basically, me have picked the ones that are giving headache to students. Okay. The next standard is these are grants, but you can stop here for today. I remind you guys to subscribe and share these videos to friends so that they can also be able to learn something. And you can comment, advice, and because we may give an advice of how you want things are to be done. Yeah, we listen to that and we'll make changes accordingly. Thank you so much.